Good afternoon, everyone. Thanks so much for joining us for another Power Play Tuesday. Today's class is going to be focused on oil and gas with Jace Graham. Very excited for this presentation. This has certainly been a hot market as of recently, so excited to hear what he has to say, some of his expertise in that industry, and what that may look like for all of us moving into the new year. Before we go into it, of course, just a very brief disclaimer before we hand the mic off to Jace. All of our content here through our educational platform is, of course, for educational purposes only. We do not provide any form of tax, legal, investment, or structuring advice. So it is important that if you are seeking this type of information, that you go through the proper parties to retrieve it. With that said, I am going to go ahead and remove myself from the screen, let Jace take it over. And throughout the presentation, I encourage you to engage with them in the chat. Let us know what your questions are and how we can help at the very end. We'll take those questions and also go over a few exciting events that are coming up for us as well. So with that said, Jace, it is all yours.
Hey, thanks, Brianna. Appreciate you guys taking the time today. If you're in Central Time, taking the lunch break to learn a little bit about investing in oil and gas minerals. So excited to be here and spend a little bit, probably about 30 minutes going over what the asset class looks like. And then we're going to open it up for some Q&A. So just a quick little backstory on me. Born and raised Dallas, Texas. I'm a fourth generation oil and gas professional. My great granddad sold a dry goods store up in Muskogee, Oklahoma for a trailer of drill pipe and moved to Tyler, Texas, about 80 years ago. And family's been in the business ever since. And I spent the last 20 years acquiring and managing several million in oil and gas minerals and royalties throughout the United States. I've been doing several drilling deals. We're actually going out leasing acreage and doing drilling opportunities. Started my career as a landman, running title at the courthouse up in Colorado. So basically running the Grand Tour Grantee Index books back to when the president first deeded the land out to the settlers. And so we would trace the title back to kind of chain it and look for mineral ownership to see who owns the minerals. And I'll explain a little bit more about that in the presentation. Currently, Rising Phoenix, we manage about 60 million in mineral and royalty assets. We have a series of mineral funds that we call our income strategy. And I'm also in real estate, do some hard money lending, private money lending, capital raising. We got about 20 real estate notes, looking to expand that to 100 this year. So we play in different facets of the real estate business. And we just rolled out our new growth strategy with Rising Phoenix Capital called the JASPO Fund. So it's a drilling deal that we did, a little bit different than participating in minerals, but I thought I'd just highlight that. So what we're going to discuss today, we're going to talk about, first and foremost, I think it's important to kind of understand, where does this energy come from? There's a lot of talk about, electricity and electronic, EV vehicles and whatnot, but where does it come from? What's our current demand? And then kind of bringing it down to, okay, where does this come from? Where are the minerals located? And then how do you receive royalty payments? How do you own minerals? How do you evaluate these deals? And then kind of looking at how we acquire, or how you can go out and acquire minerals throughout the United States, show you how we do it, and then ways to invest. And I can kind of end it on, our next fund that's rolling out next week called Maroon Bells, which is one of our income producing funds. So let's start where, our sources of energy in the United States. As you can see kind of on that left side of the chart, a little over 60% of all energy that's produced in the United States comes from either oil or natural gas. The balance comes from coal and nuclear and renewables. So, I always look at it, coal seems to be the energy source of the past. Even though they say clean coal, it's kind of an oxymoron, but I think oil is the energy source of today, and natural gas is the future. The United States is pretty much sitting on the Saudi Arabia, if you will, in oil, but in natural gas. We've got extensive reserves in place from the shale plays throughout the country. And we can harvest that natural gas and generate electricity for many, many, many years to come. I think it's also important to kind of realize, all the different products that these the oil, primarily in natural gas, help create. Anything from shampoo to plastics to dishes, safety glasses, all kinds of stuff. So it's not just the gasoline that goes in our cars. There's a lot of additional demand. Even like asphalt is generated from heavy crude. So a lot of different items that are created out of oil and natural gas. Obviously, Tesla's a big thing right now, and the EV vehicles. And a lot of people ask, I'm a big proponent of battery powered vehicles, and that's fine. You just have to kind of understand and go all the way back to the source of where does the electricity come from to then generate the charge for that electric vehicle. And it stems primarily from coal and natural gas, primarily natural gas now. It was coal, 10, 20 years ago, and now it's primarily natural gas. So again, as you see more and more of these types of vehicles and the transition over to, the electronic vehicle, then you're going to continue to see a higher demand on natural gas to charge those vehicles. Just recently, Texas just approved Proposition 7, which is, basically investing upwards of $10 billion into just the infrastructure of, natural gas fired electrical plants. So again, looking out, 10, 20, 30 years out into the horizon, it's important that, we look at what's going to be generating what we have an abundance of, which is natural gas in the United States. And, making sure the infrastructure is in place. I know if those that are in Texas, ERCOT's a big thing that's kind of come through. We just went through a very cold spell, and, looks like all the natural gas fired electrical plants, for the most part, withstood the cold spell. And there weren't any delays in power and whatnot, like what happened a few years back. So it just shows that, again, we know that the supply is there, and again, putting in the infrastructure to handle the demand. LNG, liquefied natural gas, is a big thing that is on the rise. The chart to the left kind of shows, where it was and kind of where it's going. In fact, I was just in Louisiana red fishing on the Gulf, and they're putting in a massive LNG plant down there. And so we're starting to see the United States be an exporter of natural gas. Normally, natural gas has been restricted through pipeline, but now that we're able to liquefy it, put it on a tanker, and send it to other countries, such as those in Europe or South America or even over in Japan, it goes to the highest bidder. So now it's becoming a world commodity when, 20, 30, 40 years ago, it was restricted within the borders of the United States where the pipelines are. So again, just goes to show, demand will continue to increase over the foreseeable future as it, pertains to natural gas. Again, oil is also, demand is just continuing to increase just based on sheer population growth alone. So where is all this stuff located? It's all around. There's a map here that kind of shows, obviously, Texas is a very prominent producer of oil and natural gas. But these are all primarily the shale plays that have been kind of invigorated within the last, I'd say, 20 years or so, 20, 25 years ago, with the discovery in the Barnett Shale and horizontal drilling. I know sometimes it gets a bad name as far as horizontal drilling and fracking, but the reason why we're able to be energy independent is because of this. Without this, we'd be relying on, foreign oil, foreign natural gas to, quench our massive thirst and demand for that natural resource. So, the primary basins that we look at and we target, and when we're looking at buying minerals, obviously the Permian Basin out in West Texas, it's the gift that keeps on giving. It's got multiple layers, multiple stacked zones of reservoir where hydrocarbons are located. There's areas up in the north, the Bakken, the northeast, which is the Marcellus Shale and the Utica Shale, which are prominent natural gas shale basins. You got the Haynesville Shale that's in Louisiana. You got the Denver Basin, the DJ Basin up and around Colorado, and then of course there's some basins off on the West Coast. In fact, there's even some development and some oil wells right around in the city of Los Angeles. So it's all around. It's not everywhere. Fortunately, there's some states like Florida that really don't have much oil and gas, or looking up into Oregon and whatnot. But these are the areas that we target when we're going out and looking to buy minerals throughout the country. Just a quick overview on, how oil and natural gas is produced. The schematic top left is kind of the conventional way that oil and gas used to be drilled. It's still drilled this way. In fact, we're in a well right now that's drilled in a conventional manner, which is, just a straight vertical well. You drill straight down into the natural gas and or oil. And then, of course, there's pressure down below. Again, these wells are, 10,000, 12,000, 15,000 feet below the surface. So, miles below the surface is where oil and natural gas are located for the most part. And that's what we're going after here, or the operators are. The schematic top right is what a horizontal well looks like. And as you can imagine, if you look at, all the vertical wells to the right, there's 1, 2, 3, 4, 5, 6 vertical wells that it would take to, be exposed to the same amount of reservoir. If you look at that kind of light brown stripe there, that one horizontal well can drill and develop. So you can see why this is the most favorable method, especially when drilling in these tight shale plays where you have to frack to get the rock kind of broken up so that it can release the oil and the natural gas. If you just drill them vertically, like those wells off to the right, as you can see, it's just cost prohibitive. And again, the shale play revolution is really what's put us, the United States, on the map over the last 20 years, so that we're not dependent on foreign oil whatsoever. So again, there's a good thing here. I think, 99% of the time operators are doing what's prudent and doing what's regulated as far as, how they drill and complete these wells. It's highly regulated. Unfortunately, there's been some issues that have occurred in the past. And not denying that. Again, it's sometimes, drilling thousands and thousands of wells, you will have an issue every so often. Again, 99%, I think, of the wells all drilled the correct way and fracked the correct way and don't have any sort of issues with them. But it's definitely something to note. So let's talk about now, what are oil and gas mineral rights? Where do these things come from? How do you get them? And, in its basic sense, oil and gas is part of the bundles of sticks that go with real estate, go with a piece of land. You've got the timber rights, you've got the ability to build a home, you've got, access to your property, you've got the right to sell the home. And so the mineral rights come with the real estate in the beginning. And so we talk about, when the president initially patented the first, whatever state that was, initially conveyed that first piece of land or those pieces of land to the original first owner. It came with not only the surface estate, which in this drawing you can see where the house is, but also the air rights and the minerals down below. And they say from the center of the earth to the zenith in the sky is what's owned when you have a true conveyance of surface and mineral estate. And so how does it, how do you convey minerals, and how do you get to own minerals? Well, in the beginning, it's all together. The surface estate and the mineral estate are as one. But what can happen over time is the owner of that mineral and surface estate can determine whether they sell the entire mineral estate with the surface estate, or they can reserve the minerals. They can reserve 50% of the minerals. So I can sell 100 acres and reserve 50% of the minerals. And so 50 mineral acres I would own, and then 50 mineral acres would get conveyed to the new owner, along with 100% of the surface. So it's important to note that in the United States is the only country in the United States where the mineral estate and the surface estate are owned fee simple, owned by someone other than the government. And so, these minerals, especially in some of these active basins like the Permian Basin and areas of the Northeast where oil was first discovered by Sir Francis Drake, minerals have been reserved for some cases 100 years when oil was first discovered. And, then they're passed down to families, and they've got kids, and it gets kind of spread out, and it's all done through a mineral and royalty conveyance. Minerals are conveyed that way, just like real estate is done through a general warranty deed. You convey minerals through a mineral deed or mineral and royalty deed. And so, you can see these in their deed records. They're filed of record in the same county courthouse that the real estate records are filed. And so that's what we actually go in and look at and try to kind of uncover, kind of chaining that title to see where that fractional interest went. It could have been severed 50 years ago. And then, it was inherited by 4 kids. And then they passed it down to each having 2 kids. So you can see how this can get kind of fractionalized. And, that's kind of where sometimes the opportunity lies. As it gets passed down, and the kids or whoever whoever inherited may no longer want it. Maybe they just want to get a lump sum payout, and that's kind of how we identify opportunities to go after and acquire. So a little bit about to compare oil and gas royalties with real estate, because I think it's important. A lot of people kind of understand the nuances of real estate and how it performs. And so just to kind of compare the two here, in real estate, obviously you got monthly cash flow from the property from rent. On the oil and gas mineral side, you got monthly cash flow from the wells. So these pump jacks are going 24/7, 365 days a year, rain or shine. And there's no tenants and toilets with them. So you get whatever's coming out of the ground as a mineral owner, you get a percentage of that revenue. Okay. And I'm going to step through that a little bit more detail here in a minute. The tenants pay rent, and then operators pay royalties. So you've got operators, as established as say ExxonMobil or Chevron paying you a monthly royalty payment. Management upkeep and expenses. On the rental side, on owning minerals, there's no upkeep. It's the operator takes care of that. We just get a nice little monthly check, a little bit of mailbox money. Limited growth or upside potential. And there's a lot of growth and upside potential on the mineral side. What I mean by that on the royalty side is that, on the real estate side, that if you owned a rental property, you can't add additional floors to it. I guess you could, but no one really does, but add additional floors at no cost and get additional income streams. Where on the real estate, the mineral side, you can buy that mineral interest one time, and operators can drill additional wells in the future that you don't have to pay for. You just get the benefit on that additional royalty stream. So something that's extremely interesting about the mineral royalty interest is that just that long-term upside that is realized as operators get more efficient in their drilling. They tighten up the spacing, and they're able to drill more wells in a certain area, or even just re-stimulate the existing wells that they own. So again, a lot of upside owning minerals for just without having to pay for that additional upside. Yields typically capped at kind of a 10 cap. I'm seeing yields here in the real estate world right now is triple nets are at a 4 to 5% cap rate. Annual yields begin at 10%. Our funds have been averaging, I think, around 18% over the last 12 months on a cash-on-cash yield basis. And the investor pays the property taxes. On the royalty side, we get a 15% tax credit for depletion. What that means is if you earn, let's say, $10,000 in royalty income for the year, you pay tax on $8,500, and you can do that in perpetuity. So there's a little tax break as well. So let's jump in and talk a little bit about the legal descriptions and how all this comes together as far as, where all this stuff is. Legal descriptions on, the surface is done through township and range. So nice little squares like you see on the right. There's also meets and bounds, which you see more prevalent in Texas and some other states. But meets and bounds is, where you're kind of meandering and, we go to that tree and over to that fence post, and you're basically explaining this many feet and so on and so forth at this degree to kind of come up with, your parcel of property. Where township and range is nice, neat little squares. 1 mile by 1 mile is a section, comprises of 640 acres. So these next two slides, a little busy, but I think it's important to really kind of step through this because it's kind of interesting on how a royalty owner, how a mineral owner ultimately starts to get royalty payments. And so let's just take this example here. Let's just say that we've got Farmer Brown, and he owns the surface and the minerals on 640 acres of land, 1 square mile by 1 square mile. So the little square at the top is kind of a top-down view looking straight down, and that red line on the left is a horizontal well, as you can see below, kind of top-down looking from the surface location all the way to the end location. And so the way we determine this, Exxon will reach out to Farmer Brown if they believe that he owns minerals that could be economic, meaning that they believe that there's hydrocarbons, that there's oil and or natural gas underneath his land. And so ExxonMobil will do extensive studies on this. They'll use geologists and whatnot to kind of identify, where they think the reservoir is located. After doing that, and they say, hey, we believe that there's oil over there under Farmer Brown's acreage, they're going to reach out. They'll use a landman. Again, that's what I did initially when I started in the business over 20 years ago, that will contact Farmer Brown and say, hey, I work for ExxonMobil. I was doing some title work at the courthouse, and I noticed that you own the surface as well as the minerals on your 640 acre tract. And he'll say, Exxon is interested in leasing. They love to lease your land for your minerals for 5 years. They've got 5 years to drill at least one well to hold that acreage. And they're going to I'm going to give you $1,000 an acre in bonuses, which equates to about $640,000 or exactly $640,000. And then I'm going to pay you 20% royalty revenue. If anything that comes out of the ground, you get 20% of the revenue. We, Exxon, get 80%, but we're putting up all the cost to drill and develop these wells. You don't have to put up anything. And Farmer Brown says, well, hey, that sounds good. And so they drill a well. Exxon drills a well, let's just say after, 1 year. They've got 5 years. If they don't drill a well in 5 years, then that lease goes away. These leases are filed of record, same place where, the warranty deeds are filed with real estate. And so, the Exxon's got that much time to drill that well. And once they do, and it starts producing, then Farmer Brown starts to receive the royalty revenue. And if you kind of look at how he gets paid, if he owns 640 acres and the unit's 640 acres, not always exactly the same, but let's just say in this example, and he's at a 20% royalty rate, you can see he's getting 20% of the royalty revenue. All right. If he owned 320 acres, he'd get 10% because it's in a 640 acre unit. So stepping that through here, again, let's say first month's royalty stream that oil came out of the ground, went into a tank. Tank was then sold to a purchaser, and ExxonMobil received $100,000. Typically, it's going to be a lot more than that, but for this example, let's use $100,000. In the first month, Farmer Brown's going to get a check for $20,000. Okay, right out of the chute. And he'll get a check every single month that well is producing. And what I think is important to note here is, when we come in and we buy minerals, and again, I'm going to step into kind of how we do that. A lot of times we will find situations where there is one well that is producing, and we can formulate our economics in our offer based on the one well. We also know at some point in time, Exxon can come in and drill anywhere from 3 to 4, sometimes even 5 more wells on this same acreage. So imagine this this red line here, adding 4 more of these just to the right of it, spaced out evenly across this square. That's kind of the upside potential that I was talking about in a prior slide, as far as this upside potential that we pay for the asset one time, but we get the benefit when ExxonMobil comes in and wants to drill and develop additional acreage or additional wells on our acreage. So definitely a big plus with owning the minerals. And let's say this gas produces for 30 years and Farmer Brown continuously gets paid a check for 30 years. Now, it's not always going to be the exact same because it is a declining asset, and I'll talk about that here in a minute. But it is important to note that, these wells continue to produce sometimes for as long as 50 to 60 years. And that's just the one well. If they drill additional wells, those each have 30 to 50, 60-year well lives with them as well. So looking at kind of the mineral ownership phases, we talk about acreage being, it's not leased. It could be in an area that has good geology, potential opportunity to drill a well, but it's unleased. Then it gets leased. Okay, so like I mentioned earlier, ExxonMobil, the landman, reaches out to Farmer Brown and says, hey, we believe that there's oil under your acreage, and we want to lease you. So then it's leased. So it goes from kind of, the way I look at this is kind of, if you're drilling, you're creating, you're building a toll road out to an area of town, let's just say north of Frisco. And, a developer comes in and just buys the land. Then somebody comes in and puts in the infrastructure. And then the builders come in and actually put in the homes. The top one, non-lease, would be just kind of buying the land. So it's speculative, higher risk, but potential higher reward. All right. Once it gets leased, we now have the infrastructure in, the sewers in, the water's in, the streets are in. Okay. We now have an idea that, okay, this acreage is valued by an operator. They spent the money and the time to lease it. And then they come in and they start drilling the wells, which is the producing mineral rights. This is when builders are actually building houses in the subdivision. We know it's going to be a subdivision. That risk has been taken out. That's where we like to buy. We like to buy in that area because we know that we've got wells on the property. We can underwrite those wells, and then we can make offers based on those current wells, knowing just based on our analysis that there is room for additional wells in the future. In most cases, not always, but in most cases. So how do we evaluate this stuff? Unfortunately, there's no Zillow or MLS for this kind of stuff. Somebody once asked, hey, could you not teach a class on this? And like they do in real estate. And it's a little more complicated. It's not impossible, but it's just a little more complicated as far as like how to underwrite it. We use reputable third-party reservoir engineering firms to kind of underwrite the oil wells. And what we look at is a series of things from price volatility to just the economics of the well. We'll look at post-production. What this is over bottom right is kind of decline analysis. That blue line there is kind of what the oil production is doing month over month over time. So on the left axis, you've got volume, how much oil is being produced. And then on the bottom axis, you've got time. And you can see it's a declining asset. So we need to look at that and kind of be able to underwrite. And that pink line, or orange, I should say, I need to get my eyes checked, is what the reservoir engineering firm, the petroleum engineers, are going to kind of estimate what that production is going to do over the life based on current production numbers. And so that's what we look at. And that's what we evaluate. And so we get these reserve runs, is what they're called. We get them back from the reservoir engineering firm. And then we kind of look at kind of maybe a base case, a mid case, high case scenarios. We factor in what we think price is going to do. It's kind of a guess, but we like to use the futures NYMEX strip because we can point back to it and say, hey, here's where it was at this particular point in time. And then we kind of project out what we think the future revenue and reserves and ultimately value is going to be on these wells. And then that's what we use to kind of formulate our offers. So a little bit more detailed analysis. You don't just go in and just kind of look at this stuff and try to make an offer like a cap rate, where it's just kind of held flat. You're going to be looking at a little bit more detailed. And again, if it's something you're interested in buying direct, I would reach out, and I'm happy to kind of put you in touch with some reservoir engineering firms. Again, it's not that cheap to do that, but anywhere from $2,000 to $4,000 per run, that they're going to kind of go in and underwrite this stuff and look at all the variables that we're looking at. So how do we acquire? What do we do? Kind of how do you buy this stuff? Well, just like in real estate, we do a lot of single family acquisitions in the Dallas-Fort Worth market, and it's the exact same funnel, if you will. We do a lot of cold calling, just pick up the phone and calling people. How do you find those folks? Well, in Texas, the taxes, there's taxes on the minerals. They're called ad valorem taxes. And we, just like, the county that has tax rolls for real estate, you can find the tax rolls and find people that own the minerals and then kind of back into what they're getting paid and then try to reach out to them direct. So there's a lot of cold calling involved, high ground game. Pay-per-click, online, sell my minerals fast, just like if it was a house, where we pick up leads. We do direct mail. Again, sending out letters and trying to just, educate folks on, if they want to divest some or all of their minerals. And of course, social and SEO. So doing, webinars and whatnot, and social media and whatnot. Also, we kick up opportunities of referrals and whatnot. So all this goes into, we use Follow Up Boss, the CRM. So we stay on top of our leads. We've got probably 4,000 leads in our CRM right now that we're actively working over time that own, with mineral owners that own interests all over the United States. That's another cool thing about one of our funds is that, we're not basin specific. We can look all over so long as we've got producing wells that we can go after and, run some decline analysis to get a valuation on. And then ultimately we evaluate. Obviously, we're going to evaluate, use that third-party reservoir engineering firm. Again, we use a group called Haas, very reputable here in the Dallas-Fort Worth area. They do a lot of reserve work for some of the majors. I like having kind of that analysis come to us. So it's kind of, third party, unbiased that I can look at, and then we can make decisions on what we want to offer and then ultimately purchase the asset. So heavy ground game. I've got about 4 or 5 guys at any particular time that are they're on the phones, just talking to people, talking to minerals all throughout the country. Some of our educational pieces that we push out and send, we'd like to kind of educate folks on sometimes the benefits of selling their minerals, and what they can do with that cash, you name it. So here's how to invest in the minerals. Obviously, you can inherit them. There's a lot of people that have done that, but not always the easiest way if you don't have that rich uncle. You can acquire direct, kind of like we do. Directly acquired from mineral owners using tax rolls, using lease records at the county courthouse, skip tracing those names, finding their phone numbers, finding their address, and then reaching out via either a phone call or a direct mail piece or you name it. Auctions, you can bid on auctions. There's groups like EnergyNet and Oil and Gas Clearinghouse where we like to take our assets and sell them when we buy them. And there's, people out there that will buy, assets on these public auctions. Again, I just, to take a look and really be sure that you understand the nuances of those assets, running the engineering on them to ensure that you're buying them at the right price is extremely important when you're playing on the public auctions. You can invest in, there's publicly traded mineral companies that you can invest into on the stock market. There's one called Dorchester. That's here in Dallas that has a great attractive yield, no debt. The only thing is it's not a direct investment in the minerals themselves because you're investing into a company that's on the stock market. So if you're looking to diversify the portfolio, maybe get out of some stocks and bonds or just stock market altogether, unfortunately, that going that route doesn't necessarily work. And then, of course, you can invest into a fund, and that's what we do at Rising Phoenix, where we create these mineral funds. We'll do anywhere from 15 to 20 million in placement a year. Currently, about 35 million of assets under management that we have here that we currently manage. Again, we look to sell these funds every 2 to 5 years, depending on where they are in their life cycle and where commodity prices are. And this is kind of how we generate these opportunities. We're targeting the top basins. We're targeting the Permian. We're looking at areas in the Haynesville and up in the Marcellus where we've got good rock. We're looking for good operators, publicly traded, well-funded operators is who we like to target and buy the minerals underneath. Just like that interest that Farmer Brown owned with ExxonMobil, we want to own that stuff under those types of operators. We've got some kind of unique proprietary software where we're able to take kind of tax roll data and then, merge it with, current production data to kind of get estimated check stub value, something that we've kind of formulated over the last 4 or 5 years that kind of allows us to kind of get an idea of what individual mineral owners are receiving on a monthly as far as their check stubs. Because a lot of times when we go out and talk to them, we need their check stubs in order to formulate an offer. Well, this allows us to kind of get a head start because we're able to kind of see a little bit on what we believe they own based on the decimals of interest that they own in the wells, and then what the operators are reporting to the state comptroller. So something that's kind of unique. Again, looking at life events, there's, various ways and stuff that kind of may throw up some additional red flags, and maybe people may be more motivated to sell than the next guy. Could be anything from tax liens to probate to divorce decrees, you name it. And of course, we're looking for active drilling. Where is an area that's active? Where are operators adding additional permits in future wells to drill and develop? Just briefly on our next fund, we've got Maroon Bells rolling out. It's a $10 million income fund. This is what this is our bread and butter. This is what I've been doing for the better half of, almost 25 years. Going out, finding producing minerals, aggregating those into a fund, and then doing distributions out to our investors on a monthly basis. So it's truly mailbox money. Kind of the cash on cash yield projection, the 5-year, we've got, like I said, we've got roughly 35 million in play right now, where we could actually speak to this, where the return profiles are a little bit higher. But this is kind of what we like to project out. 8% in the first year. Again, remember, you're spending time deploying the capital, so that's why that's a little bit lower than the next years. 16%, 15, 14, and then we look to sell maybe year 5. Typically, we're going to try to sell in year 3 to 4. But again, if we held it all the way through year 5, looking at anywhere from a 1.5 to 2 to 1 return, this model shows a 1.66. So again, there's nothing too crazy sexy. I mean, we're not going out and drilling, and it's not wildcatting and all that. It's kind of, I think if you're looking at investing in oil and gas, investing in producing minerals, the minerals that already have wells drilled on them is probably the safest area to play. And so that's kind of where we like to put our funds. It's cash flowing, it's generating yield right out of the gate. And, most of our, all of our investors like that. They like getting that monthly check, and we like sending it to them. Again, this is kind of our 12-month average for the past year in 2023, just comparing it to some of the other investment categories, if you will, or investment vehicles. S&P had a strong run towards the end of last year, but we generated across all of our funds 18.2% cash on cash. As you can see on the graph on the right, that's each one of our individual funds and kind of what they averaged over each month. You saw a little dip mid-year. I mean, we saw oil and natural gas prices really, drop down significantly. And so you kind of saw that dip in the revenues, you can imagine, because it's production times price is what the royalty payment ends up being. So if prices drop drastically, you're going to see your revenue drop. But then we've seen prices kind of rebound back up, and of course, revenue follows. So something to note there. And it's always kind of good to know, like, why is my investment going up or down? Well, let's look at price. And a lot of times that'll factor that in. Just a little bit more, 10 million offering at a glance on Maroon Bells. You can go to maroonbellsfund.com or take a picture of the QR code. It'll take you to the website where you can learn more. There's some videos on there about how we underwrite with our reservoir engineering firm, how we acquire with our mineral manager, and just overall some good information on kind of the Q&A. And, we're targeting producing minerals throughout the country with attractive yields. We have audited financials, so we're very proud of that. Self-directed IRA eligible, so you can invest in that. These offerings are accredited investor only, and so we've got to verify that. But it's if that's something of interest, happy to visit with you about that. And then of course just like with anything, there are risks. So here's the high level risk associated with owning oil and gas minerals. Pricing obviously is the biggest one. Pricing volatility. Investors, once you're in a fund, you're in that fund until the fund decides to sell. Oil and gas assets do deplete. Like I said, the decline curve, we factor that depletion in the overall engineering when we work with that third-party reservoir engineering firm. We don't have any control over operations, so we can't force Exxon to drill additional wells. ExxonMobil will drill the wells when they want to. So that's, we're a passive owner. We also don't, share in any of the risk or the exposure associated with drilling those wells. And there's no guarantee that wells will operate the way existing wells are in operation. I'll kind of wrap it up with the benefits of owning oil and gas. Again, passive income. Everyone talks about that mailbox money. It is very quiet. There's very noisy ways to make money, and then there's very quiet ways, and this is definitely one of the quietest. It's a good way to diversify your portfolio, and get into, directly involved into the energy sector. It's long-term income. These wells generate income for 30 to 50, 60 years, and it's a hedge against inflation. And so, we're kind of in a higher inflation market, and again, owning commodities is always a safe bet. Capital gains, again, there's additional upside when we own. That whole accretion wedge is pretty interesting when you look at the reserve engineering that was done on one of your portfolios, and you look 2 years ago, and then you look today, what was projected, which was kind of a declining asset, and what actually happened. And it's pretty interesting to see that from time to time, as far as like what the operators ended up doing to generate more hydrocarbons, more revenue. These operators are extremely resilient and efficient, our domestic operators here in the United States, and they're going to find ways to extract as much as they can out of the formation. And of course, there's tax advantages. So the 15% depletion allowance I mentioned, that doesn't get factored into any of the return profile that we said. So overall, we love the investment. We're heavily invested in not only our funds, but also in direct investments in owning oil and gas minerals. As I say, formula for success: rise early, work hard, and strike oil. J. Paul Getty, that's my guy. So I'll leave it at that. We can open it up for some questions. I've kept you here for almost 45 minutes, so I appreciate your time and the opportunity to visit with you about oil and gas minerals. And again, if you're interested at all in learning more, check out our website, maroonbellsfund.com, or you can click on that QR code and it'll take you right there where you can learn more. You can download the investor brochure where it's more information, or you can schedule a call with us, or even call us direct. So appreciate the time today, and hopefully it was helpful and insightful.
Yeah, absolutely. And we appreciate you. Before we let you go, we have a few questions here in the chat. First, I want to address a couple comments about the screen maybe being a little bit blurry. We will be archiving this on YouTube, so hopefully you'll get a better look. And if you'd like the slide deck itself, you can email our marketing team that is in the chat. That way we can share with you anything that may have been missed in those details. So that may have just been a connection issue on this end. So apologies for that, but we will be able to share it with you. With that said, we have a question here from Carla Sims. Her question is, what is the cost to enter this market?
You can buy minerals for as cheap as, $500. It just really depends. It's just, the size of the asset. Is it in an area that's producing or not? But, like I said, you can look on EnergyNet or Oil and Gas Clearinghouse. Those are the public auctions where these types of assets can be sold. And you can see, I mean, they're everything from $1,000 all the way up to, $5 million, if not higher.
And we have another one here. It says, is this an opportunity for any investor or only accredited?
Currently, right now, it's accredited only. We are looking at opening up our first Reg D later this year, which will open it up to both accredited and non-accredited.
Very common question that we get with any opportunity that comes about. So that's really good to hear as well. All right, another question for you. How long is the lease term typically?
Typically, I mean, you can see it as short as 12 months, but I would say on average 3 years, 3 to 5 years is how long a lease is. And so an operator has that much time to drill the first well. Once they drill that first well and it's producing in paying quantities, meaning that there's a production coming out of the well and it's commercial and viable, then that lease is held in perpetuity, so long as that well is producing production payments, royalty payments to the mineral owners. And so that's something to note that, imagine you lease, drill the first well, it's held for 50 years on that one well alone. And then they drill additional wells, and each well kind of extends that life of that lease.
And this question's come up a couple times, so I'm actually going to share one. It's got 2 parts to it. The first part is the one a few people have asked, but what is the minimum investment in the mineral rights fund? And then the second part, are there any time restrictions on holding that investment?
No, great question. Minimum investment on our mineral funds is $50,000. And as far as time restrictions, we're going to hold the assets for at least a year so that we don't get hit with short-term cap gains back to the investors. We issue K1s out, and these are limited partnerships. So it'd be a 1-year hold minimum. But, we're going to be, as soon as we acquire the assets, get them into pay status, there's kind of a process, right? Deploying the capital, buying the mineral interest, getting them into pay status with the current operator. It takes anywhere from 3 to 6 months per asset.
Okay, good to know. And now Elizabeth is wondering how many funds that you currently have with Phoenix.
We currently have 6 funds at Rising Phoenix right now. 30 million assets under management. About to roll out Maroon Bells. And so that's a $10 million fund. So we're going to start steadily raising anywhere from 10 to 20 million a year for this specific strategy. We have other strategies at Rising Phoenix, like our growth strategy, and rolling out later this year our debt strategy, which is just a flat fixed return, but a few more things that we do.
Yeah, certainly sounds like a lot of opportunity coming up then there. One from Nina. How much do you invest in each deal?
We'll do anywhere, like right now, invested total across all of our funds, we're close to $1.5 million. So we'll do anywhere from 1% to 2% of our deals.
Okay, great. Sorry, just a few more here. One question here is asking for a resource for the mineral rights tax sales in Texas.
So it would be at the same the assessor's office. Is because it's considered real estate. Right. So if the county is going to foreclose on the minerals, it doesn't happen a ton. It does from time to time. It'll be at the assessor's office, same exact place where the real estate is. You'll see different conveyance deeds, and just ask that county for the mineral tax sales.
Yeah, makes sense. And then how much do you normally charge to manage the deals?
So on our funds, it's 1.5% assets under management fee. So, which is pretty typical.
Yeah. And a couple more here. This first one from Bob. I see projections for higher oil prices. However, how do you address the public's cries to no more petrochemical production?
Yeah, I mean, it's an interesting question. Understand the public's cry for no more petrochemical production, but I mean, the truth of the matter is just, looking at that first chart, that the supply demand is there. It's just, if we curtail, I think we saw it when Biden restricted federal land drilling, not picking one part or the other, but what ended up happening was oil prices went through the roof because restricting
Right.
production, demand increasing, just pure supply demand economics, prices go up. So owning minerals in a situation where the government is trying to restrict production actually increases commodity prices. And as a mineral owner, that's a good thing. So, again, it's there's a lot going on there, but that's why I think natural gas is clean. Um, and that's why I say, like, we're the Saudi Arabia of natural gas. We're putting a lot of infrastructure for natural gas for the decades to come. And so I think that you're going to see kind of moving from oil more into natural gas over the years to come.
One more from Yuan. They're asking if you could share the performance of your other funds. I know you do have your contact information up there. That may be a better avenue for that. But if you have a moment to share a little bit more about that, please do.
Yeah, there's all kinds of charts and graphs depicted on the website maroonbellsfund.com, where we kind of show what the other funds are returning. We've also gone out. We've had third party underwriting done on the Maroon Bells Fund by a very reputable company that underwrites these types of offerings, called Mick Law out of Omaha. And they understand the nuances of oil and gas and these types of investments. And we spent the better part of 3-4 months with them going over all of our returns. They had to verify, validate all of that to ensure that what we were reporting was actually in fact true. And so that report will be available in the data room. We're actually going to be opening up the data room for Maroon Bells next week. And so that report will be part of the offering documents for anybody that's interested in looking at one of our funds can take a look at. So
great. And then that also goes back to if you didn't get a chance to grab that contact information, certainly reach out, request the slide deck. We'll send that your way so you can get all the information you would need to feel comfortable moving forward into an opportunity like this. I have one more for you before we will let you go and close out with some announcements.
Okay.
Where is this next fund for?
So this next fund, I mean, we're agnostic. So we look all over. Again, the main thing that we're looking at first and foremost for these funds is, do we have producing wells, and are we in good rock, good basins with good operators? And so that allows us to kind of open up where we want to look. And so, just looking at all of our funds combined currently, we're buying in the Permian, we're buying the Marcellus Shale, which is the Northeast, Haynesville Shale in Louisiana. So the prominent shale basins that are known is typically where we're playing in.
Great. Well, that is all of the questions it looks like that we have time for right now. Of course, any additional questions we did not get the chance to get to, feel free to reach out to Jace directly. I'm sure he'll be very happy to share that information with you. We want to thank you for coming out and talking. Like I said, within the past, I'd say year, maybe a little bit over that, we've certainly seen a lot of interest in oil and gas, and specifically in mineral rights. So great to have this education on our platform, and we very much appreciate you coming and sharing your expertise.
Sure, no problem.
Perfect. And before everyone goes today, we are going to take just a moment to go over some announcements for some events that we have, as well as how you may be able to get started investing into something like this with an IRA or 401k money you have out there. This is a QR code that will allow you to schedule with an IRA specialist. We'd be happy to share the link for this class with you. That way you can dive into a little bit more of the details that were within the presentation on your own time as well. Feel free to scan, talk to us about what it is you're looking to do and how we may be able to help with that. If you're planning to get started sooner rather than later, we do actually have a promotion running until the end of January. This will allow us to waive the $100 establishment fee up to 50%. So you're only paying $50 for a new account for you to really open yourself up to many opportunities out there. So I highly encourage you to reach out to us, schedule that consultation. That way we can get you in touch with people just like Jace who may have opportunities for you to dive into a little bit more beyond your typical stock market investments. With that said, I do want to mention our upcoming socials at our Houston, Austin, and Dallas office. For those of you familiar with Quest, we know that we used to do these monthly, but now they are quarterly. So this is our quarterly social. We're projecting quite a few people coming into each of the 3 offices. Houston and Dallas are going to be in person and online. However, Austin will solely be in person. So we do encourage you that if you can make it, please do. The dynamic duos is the topic for these classes, and ultimately it's going to talk about power couples out there who have been partnering for their own success in the alternative investing industry. So we would love to have you out. You can register for free through our website. I know Juan, who is moderating, is putting all those links in the chat for you. So feel free to check us out and register. We would love to have you out. And last but certainly not least, I want to touch on the Quest Expo. We are back again this year in Irving, Texas. So that's the Dallas area for those of you who may not be familiar. This is going to be our largest event yet. Again, all focused on alternative investing, oil and gas, private lending, multifamily, really anything not publicly traded. We're going to have experts here speaking to you about. So we would love to have you come out for that as well. This is our largest event of the year. So we're very much looking forward to putting this on once more. And you will see the link for you to register now. Right now, ticket prices are cheaper than they will be here in the coming months. So I encourage you to register sooner rather than later. You can also reach out to me directly. My name is Brianna. Give us a call at our main line, ask to speak with me, and I'll be happy to help you out with that registration as well. But that is about all I have in ways of the announcements. I am going to go ahead and let everyone go. And again, just last thank you to you, Jace. We appreciate you taking the time out of your day and sharing all this information with us.
No, you're welcome. Thank you for the time.
Of course. Bye, everyone. We will see you same time, same place on Saturday.